Darren, many thanks for making time to speak to us. Busy day.
Thanks, Arnold. Yeah,
what don't we know so far? What's in the figures?
No, I think the market's pretty happy with what we've done in terms of our South African and African Middle East business. Obviously, battling to digest some of the challenges we've got in the UK. So I suppose it's a tale of two stories, really. But in terms of our core business, I think it's delivered good results through a very tough period.
Darren, looking at the graph right there, one of 3.05, that's of course the stock price right now in the Jersey. Definitely, even with the headwinds that we have seen maybe in the UK, good performance, at least Middle East, like you're saying, and South Africa. Do you get the sense that this is not about to actually bite in, at least in the near term?
Yeah, I think the market's fairly understanding of where we're at, and I think we've put a program in place to mitigate the challenges in the UK, as well as another manufacturing business that we've got called Concentrate that has been challenging. So I think the market can see that there's some work happening in our business to really focus on our core brands and our core business being our leading brands, and obviously getting the value through the supply chain from performance in those brands.
Right, let's talk about that UK market. I was just reading a statement, and one of the headwinds that you do actually point out is the uncertainty that is coming with Brexit. Now, away from the currency volatility, Brexit as Brexit, no deal as per now. In the midterm, do you see this actually turning around, at least the uncertainty on the political scene?
Yeah, look, I wouldn't like to tread into the political sphere. All I can tell you that from our colleagues there, and, there's just such lack of clarity, and every day brings more uncertainty rather than less. But from our perspective, we're pretty confident that I think we're getting through the worst. We've got a restructure strategy that's in place, so I think we can make the best of a very tough situation right now.
I think one thing that stands out on the UK figures that I was going through, Wimpy, surprisingly actually doing well, up what, 18.2%, as opposed to GBK, which is down 2.9%. That's on the revenue side, which is quite fascinating. You would have thought GBK, more upscale and everything, would be doing way better than Wimpy. Just give us a sense of the rationale here.
Yeah, I think those numbers are slightly skewed because there's been some currency gain there, so those are not the local numbers, but the trend is exactly as you say it is, so one up, one down. The fundamental issue is that Wimpy's target market is slightly different, and if you think about the UK, the more premium top end of the sector, I mean, quite simply, they're just spending less often, so they're just, typically their repertoire is reduced, whereas probably, middle to mainstream income, people are still adopting the same frequency. And Wimpy's got a much smaller presence in terms of the upper income market. So it really is people cutting back. It's not that they're not using the brand anymore or other brands, it's just that they're just using, their frequency has declined. And also the online food trend is that GBK was ahead of the curve and Wimpy behind, and Wimpy's getting some benefit from some of that catch up. And GBK is finding it, there are a lot more people coming onto these platforms, which made it harder for us to compete, but we've done a lot of work to mitigate that. So Wimpy is getting some tailwind from delivery as well.
The other thing that's quite fascinating is the dividend. Now, no dividend has been declared for this time round, but some market watchers out there were saying that there was a declaration a few years ago that if at all the HEPS did get to 2%, then we would be actually, that's of course in relation to the debt ratio, we would be seeing a dividend. Are we about to be seeing one anytime soon, and why haven't you declared one for this time?
Yeah, we don't have a dividend policy, but I mean, we have said that we would like to get the dividend back. Certainly not in this declaration. There is opportunity going forward, but we haven't given any certainty around that. I think maybe some of the commentators you've spoken to are probably looking at the cash position, saying that there's an ability to do that, but we obviously have to work with our lenders around trying to review that debt profile to just better align with the business. So currently you've got cash generation, but there's a debt structure in place, and it's difficult to find a common ground. So we're busy working with lenders, and I think we'll have that resolved fairly soon.
It's very fascinating. Some stores have been closed. You do mention around 6 of them already. Well, what are the metrics here going forward? What stores are earmarked, or what do you actually look at in terms of variables before closing these? Is it just revenue streams not coming in, or traffic? What do you actually look at here?
So the 6 is specifically the UK and GBK, and it's very much an EBITDA at store level metric. So I mean, quite simply, if it's not contributing to EBITDA, or it's cheaper to effectively close it in terms of the rental cost being cheaper than the EBITDA contribution, then that would be your metric. So that's really the principle we've used regarding the CVA restructure strategy. And there's around 17 sites that fit that bill in terms of that criteria.
Right, and you're also looking at some refurbishment of some high street establishments. This is all in relation to the UK, if I'm right?
No, so our revamp program cuts across our business. So in terms of our entire business, come the end of February 19, which will be the full year, we would have done around 255 revamps, of which a small portion would be the UK. So refurbishment is, whether it's our own stores or franchisee stores, is part of the program, and really just aligning to consumer expectations and keeping refreshed, keeping modernized, in line with trend.
Right. Let's talk some FX exposure here, because you're operating in a market that, regardless of the headwinds that are in the UK with the Brexit uncertainty, the pound is still strong, to be honest. And how much risk here do you face in terms of FX volatility and FX exposure risk, to be honest? How much of that do you face here?
Not a lot of inherent risk. I mean, obviously our earnings are at risk, or there's upside like there has been, and there's potentially downside. It's just we've got the timing wrong, where you're making losses and the rand changes against you, just makes the loss slightly bigger. So unfortunately we haven't had much luck along the way. But no, I don't think there's a significant risk factor in terms of earnings. I mean, we report every 6 months. I don't think that there's an underlying inherent risk. There's upside and downside, of course, as you've seen over time with the wimpy UK earnings. Sometimes we're getting the upside, and other times it down. And the same in the Africa business, really. This time last year we were really struggling with a strong rand.
The Africa story here, it's quite fascinating. I mean, franchising from maybe Ethiopia, then you cross to Kenya, then you have Nigeria. Which countries actually do stick out for you, at least in the numbers? Because many of the figures that we are looking at here are a more aggregate figure. If you were to break it down, which countries actually do stick out here? Yeah,
so we're trying to get a lot more focus. So we've got what we call a deep and narrow strategy. And I mean, I'm an African optimist in terms of some of those markets. So some are more exciting, but they're not delivering the numbers. I mean, the real key drivers of growth are typically the SADC countries. So, Botswana, Zambia, and Malawi as an example, if you go further north. Ethiopia is a great prospect and very exciting, but the numbers are quite low. So the real kind of sleeping giants are Nigeria, where we've got quite a strong presence, but need to keep doing more work, and Kenya.
VAT, the hike that we did see earlier on this year, what are the mitigations here, at least from your end, in the near to midterm? Are you about to pass this on to the consumer? What is your strategy here?
Yeah, I think we probably did pass it on to the consumer over a period of time, but not straight away. So our menu pricing cycles were probably around May, so a little bit after. But I think food inflation has been quite tame, so probably very little of it got passed through in terms of that particular. But over time, I mean, one can't hide it, it does get passed through over time. And I think it's probably been muted some of the turnovers, to be honest with you. I mean, it hasn't been a buoyant period. I mean, we've done particularly well given tough conditions. But I think in our business, probably the petrol price has got more of an impact than VAT.
I was going through the figures here, and on your impairment section, it's quite fascinating where you do mention that the recoverable amount from, at least this is in relation to GBK, you are looking at close to 1.45. This is in billion rand, and your projections are quite optimistic. We're looking at 0%, increasing to 3% over the next 10 years. This is quite optimistic. What informs this figure?
No, I wouldn't say it's optimistic. I think it's probably middle of the road. To get growth back to zero is not the biggest challenge. So from 0 to 3, it will depend a little bit on what's happening with inflation in the UK. So inflation will help, but no, I don't think it's optimistic. I mean, I think we are in a very difficult. If you look at where we are now at kind of minus 9%, then it's a tall order. But I mean, we're already starting to see some easing of that. So no, I think over a period of time, and relative to the historical growth rates, I mean, it's a relatively easy walk in the park. But you have to view these things all the time. So the impairment model is checked every 6 months.
Darren, before I let you go, minus 9. There are many investors out there who might be saying, is it time for you to consider cutting your ties? I mean, someone I was talking to just before saying that you inherited this, when you came in, the GBK saga. Is this on the table to actually cut your losses and just let it go?
Yeah, it's not a personal thing around inherit or not. I mean, the business took the decision. I was on the board at the time as well. So it's not around that. I think that the issue is, do do you see upside or not? And we have to protect shareholders' returns as well. So at the moment, it's one step at a time. Our focus right now is between now and the 9th of November on the CVA process, and we'll take it one step further. But we're always evaluating our business. So it doesn't matter what business unit it is, whether it be GBK, Cocoa Concentrate, or anything else, we're always looking at strategic options to do what's right for our business, our franchise partners, and shareholders.
Darren, many thanks for making time to speak to us. That was Famous Brands CEO Darren Hele.